Okay, folks, so there's the saying that you could have the best ship in the world. The best ship. Better than everybody else's ships. You can go and brag to your friends that your ship is so much better and their ship sucks. You could have the best ship in the world, but if the captain of that ship doesn't know where to go, well, the ship is just going to drift around aimlessly. And when a captain goes out to sea, there's many things that aren't in the captain's control. Whether there's an engine failure, whether there's huge tides, whether there's a massive hurricane coming, or even whether there's a mutiny on the ship. But you see, the captain still needs to have a clear plan and a clear direction to guide the ship through all these issues in order to what? Well, get to the final destination. In a similar way, we are all captains of our own account. Yet, when it comes to the stock market, what happens? A lot of people go and they have no clear direction, they don't know what they're doing, they have no philosophy to live by, and they don't know exactly what the destination even looks like. Folks, in this video, I'm going to give you a violent step-by-step philosophy for growing your account in 2022. This is a no BS, no nonsense philosophy that I myself aim as closely as possible to follow. This is a simple philosophy for high conviction trades that I believe will help you grow your account dramatically and also allow you to sleep without sweating. Okay, so step one of the philosophy. Find 30 plus stocks that you're interested in diverse sectors. That doesn't mean buy 30 stocks, it means find 30 stocks across different sectors that interest you and provide ample diversification. Ideally, you have some big caps, some medium caps, and some small caps, and ideally you have actually different industries. For example, financial services, tech, different sectors of growth tech, healthcare, entertainment, telecom, manufacturing, energy, whatever sectors you're bullish on, make sure that you pick 30 stocks from a myriad of different sectors. You probably already have at least 5 to 10 stocks that you know very well, but ideally this list of 30 stocks is a list that you've compiled slowly over time, took you at least a month or two to build any sort of knowledge in them, and these are stocks that you have a fairly decent grasp on it. Obviously, you're not going to be able to follow 30 stocks very closely to a T, but these are your 30 top stocks in different sectors that are diversified very well. Put them on a damn list, check them twice, make sure that you see which ones are naughty or nice. And if the ticker Mar has been on it, just know she's been very naughty. And once you've been doing this for long enough, eventually you'll start curtailing your top 30 stocks to match more of your own projections and risk tolerance and allocations that you see as the most fitting for your highest conviction stocks. You probably have 5 to 10 stocks in your top 30 that are the highest conviction, and you'll allocate that appropriately. More on that later. But there's no one-size-fits-all answer to this step. If you're in ZipTrader you know that I have a huge focus on growth tech in different sectors, whether that's crypto mining, electric vehicles, AI, next-gen data analytic platforms. Whether you're talking about e-commerce in developing markets or you're talking about 3D printing, those are many of the favorite companies that I believe are going to have some of the most outsized growth in the upcoming years. If you look at the top ones in the AA plus rated price target list in ZipTrader U, stocks that sit highest on my conviction list are stocks like, well, Palantir, ChargePoint, Lucid, SoFi, Upstart, AMD, but you'll also find some diversification with other companies like a Boeing, a Visa, or an American Express. But the thing is, the reason this is no one size fits all is because your own list of stocks to choose from is going to be based on your own projections for the future, where the best growth is going to come from, but also how much risk you want in your portfolio. The more uncertainty and unclear the potential of a stock is to the rest of the market, the more reward you get if you're right, but the more punishment you get if you're wrong. So you have to curtail your picks in this step to stocks that make sense based on your own personality and your own risk tolerance. You can't just pick stocks that other people are picking because you have a different risk tolerance and outlook than them. And you probably also have a different price point. And that leads me to number 2, which is set a fair price target. So you can make endless videos and write endless books about how to set a price target, and people have. But for the purposes of this breakdown video, my best advice to you, and the best thing that I could say within a minute time span, is start by crafting a simple spreadsheet like you've seen in many of my videos and like you're seeing here, and forecast your company's expected revenue growth rates, shares outstanding, expected dilution, and then churn that out to come up with a fair value based on a fair multiple that you're seeing in a lot of the other stocks in said industry that are more mature, but also ones that are in the same stage as your company so that you can see what the fair value is at the current present moment based on where the other companies are trading. In terms of the calculation, the fair value using this formula is simple simply the revenue divided by the shares outstanding multiplied by the multiple. So you divide this by this, and then you multiply it by whatever multiple you think is appropriate. It gets a lot more complicated when you get into the actual earnings, if your company is profitable or not, and if you want to compare the actual multiples based on different multiple conditions. And again, there's no way that I can do justice for this in a single video. There's a million different philosophies to setting price targets. There's a ton of free content online. And in ZipTrader U, of course, we have a ton of content on not just how to do your due diligence in a very, very violent way, but how to value companies using spreadsheet analysis, how to take into consideration technical analysis to factor in exactly how a fair range of the stock is negotiated, and different ways to compare different price targets for different companies. But again, there's a lot of information online and a lot of different ways to get to that price target. But the key is that you have to be price target, or you have to be very confident in your price target. You don't have to be price target. I don't want you to be a price target. I want you to be a person who sets price targets. But you get my point. Step 3 is buy when 30% or more below price target. So this is a big issue for lots of folks. We see a company we like and we want to pay any price for it because, ooh, shiny. If your price target on something is $100 and you see it trading at $105, where the hell is your margin? If the stock's at $90 and you see it trading for $100, where's really the margin there either? You only got $10 of upside, and dysphoria cycles can get that down a lot lower than $90. You only have $10 of upside, and there may be a lot more upside in a completely different setup somewhere else that you could better deploy that capital. You want to get something that's a good deal, and to me, 30% off is a good deal. Now, the other side of the coin is there's a lot of people that will like a stock when it's near its price target, and then it'll drop 30% and actually fit the criteria here. And then they'll say, well, I don't want to buy it because what if it's a triple layer dip? But here's the thing, if you're not confident in buying the dip when you see it as a fair deal, that means quite simply you're not confident in your analysis, and you need to go back to step 2, which is find a accurate price target. It's fine to just buy a little bit and nibble as it dips below 30%, but if you set a price target and you don't think that it's worth the price target, you shouldn't be having that price target. Buy the dip when it dips appropriately. Add more if it dips more. You should be buying systematically and unemotionally. Who cares if it's a triple layer dip? Great, buy more. You don't want to buy more? Well, you didn't like that stock very much to begin with. Number 4, be aware that you need to update your price target based on earnings and new information if it changes the data and the numbers of your estimates. If it's justified, you have to be willing to change the price target. Now, that doesn't mean change the price target based on where the stock is trading. If the stock went up 300-400% because, ooh, all the hedge funds are buying it because they're exploiting those uptrends, well, that doesn't mean that the stock is worth a lot more. It means that you got lucky and it factored in your price target a lot faster than it should have. And similarly, if the stock gets beat down massively because, ooh, hedge funds are shorting it, or ooh, interest rates or whatever, then that doesn't mean that the company is worth less because all of a sudden the market wants to short and distort it. Upgrades or downgrades on your price target have to be based on what the company is actually doing, or at least the industry. If it doesn't affect the revenue projections or the earnings projections of your company, then it should not affect the price target. Just because Joe Blow said you're going to be a bag holder and you're an idiot if you hold a stock because now it's down, well, that is not a good enough reason to downgrade a price target. If you're uncertain in your price target because it's down, that's fine. Go ahead and go back to the data. But if the data still justifies a higher price target, you have to be true to your analysis. A price target gives you a bearing on what something is worth, regardless of FUD or favor. So you can't use what's happening in the emotions of the market to judge the company's value, or else the price target is useless. It's also a good rule of thumb that if you have to update a price target more than twice a quarter, you probably don't have a good enough grasp on the company. I struggle with this, everybody does. If you're uncertain of what the price target is, I found it's just better to get rid of the price target and just drop the conviction play. If you're debating what the fair value is, especially during good times, well, you're definitely going to be debating it during bad times. So instead, stop that disaster before it happens and drop the conviction play if you don't understand what the price should be. Okay, next, number 5. So this one is another one that a lot of people have a very, very difficult time doing, and that is trim when something is getting euphoric and add when it's getting fearful. How many times have you heard somebody say, oh, you got to let your winners run. Just let them run forever. And then when they drop, they're like, oh, you held a fallen knife, you loser. Ho, 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 ho. No. Holding something because, ooh, moon, isn't a justifiable reason to be in a position. You have to have a clear plan to be in that position. And in this case, with a high conviction play, that means a price target. If something has passed your price target, it's time to start trimming. If something has gotten very, very close to your price target, like 3 days or 3 weeks after hitting it, and you thought it would take 6 months, then it's also time to start trimming. There's been a few examples where we set price targets on plays and they hit the price target a lot faster than expected, or at least near the price target a lot faster than expected. And hey, it was time to take profits early because it didn't make sense in terms of a deployment standpoint to hold that position, because if it went back down and it went back down 50% and took a year more to recover, then that wouldn't have been a good use of capital. Take the profits when it makes sense. Trim as it makes sense. Rarely will I argue for trimming all of your profits off the table unless you hit your full price target. But if you have a huge flurry of euphoria into your stock all of a sudden, and it happens a lot faster than expected, take some profits off the table. Trim before the price target if you have to. And on the opposite side, when people are fearful and people are scared and people think your stock is trash, if a stock you liked at $100 is now trading at $85 or $75, don't think, okay, I was wrong, it's a trash stock. Think, ooh, good time to add some moolah. Let everybody else be fearful and scared and little babies while you're going and sitting and adding on those dips. Charlie, I don't feel confident adding during fear. Okay, well again, if you don't feel confident adding during fear, then you have to go back to step number 2 and maybe even step number 1. Because if you don't have any conviction in the stocks that you valued, you chose the wrong stocks, or you didn't do the work to actually build that conviction. And lastly, take profits when hitting a price target. If you bought a stock at $8 and set the price target to 20 and now it's at 20, what do? Take profits. In a situation where it's hit that price target and you've justified an upgrade to the price target, fine. Trim some off the table and let it run to the new price target. But if you've done the numbers based on what the company's doing, not the stock, but what the company's doing, and you can't justify an increase, an upgrade in the price target, take your damn profits off the table. But Charlie, I read that it's going to the moon. Okay. But the moon is not a quantifiable location, at least not in the market. There's not a stage where it says, okay, you've reached the moon now. Now on the other side of the spectrum, if you have a stock that you valued at a certain price and then you had to go and downgrade the price target and you're also red on the position, well, if you're already at that new downgraded price target, well, go ahead and sell out of the position, even if that means at a loss. I don't like the whole mentality of, oh, I have to wait until it breaks even. Wait a second, why do you have to wait until it breaks even? If you don't believe it's worth that break-even price anymore, go ahead and redeploy it in a stock that actually has upside where you believe it is worth that upside. You could probably even tax loss harvest some on that old position that you lost money on. So no harm, no foul. Or less harm, less foul. I have to break even on this stock is an emotional idea. It's not a logical one. I have felt that as well. Oh, I have a bad stock. Ooh, I'll just wait until it's not a bad stock anymore. But why? That capital could be better redeployed somewhere else. You should never be down, never, ever, ever be down on a stock that you don't believe is worth more than the current value. Okay, I want to finish you off with some good housekeeping and some clarifications. Obviously, you could write a whole book about each of these steps, but some of these housekeeping tips are essential to talk about. So number 1, I would aim to, in the long run, have at least 15 stocks invested in. So over the course of 5 years, for example, on average, you have at minimum 15 stocks that you're exposed to at any point. Obviously, some market conditions are going to be very, very cash heavy because you're having all of these stocks that are way over their price targets and you don't see any good deals. But if you're in a lot of different sectors, there should be some sectors that have very good deals and other sectors that don't at any given point. So most of the time, if you have a full list of 30 plus stocks, you should have at least 15 that you're holding on average. If you're in a situation with a new account, obviously that doesn't mean just go buy 15 stocks, go panic buy them. What it means is find the stocks now, and then as they become good deals, start buying them. Start slowly adding into them. You don't need to have $5 million to put into the stock market. Put $50 in. Put $500 in, and then slowly and consistently add to your highest conviction plays. But have at least 15 minimum over the long run. Also okay and actually encouraged to allocate the highest conviction stocks heavier. You are only one person and you're not going to have all this time to learn every single nut and cranny about every single stock on this list. So you probably have maybe 4 or 5 stocks that you really know really well and you really believe in more so than the rest of the market. So those top 5 stocks, your favorite stocks, you could allocate a lot more to them, and you could have 1 or 2 that you allocate the most to. If you have 30 stocks, then Tesla and Alphabet and ChargePoint and Palantir, combination of small caps and large caps are your favorite, hey, go ahead and allocate more to them. But I would still aim to not let the top 5 take up more than 30% of your portfolio. Some people would say that's even a lot, but I see what a lot of retail traders do is they'll go and they'll buy 1 or 2 high conviction stocks and they'll take up 90% of their portfolio and one of them fails. Well, what happens? Well, they get destroyed and they're like, yep, the stock market's a scam. It's rigged. Yes, it's rigged, but we can also push back by rigging it with a simple philosophy. The ocean is rigged not to let you cross it, but ships let you cross it. Next, to reiterate an earlier point, it's okay to take profits as soon as you've hit your goal. If you buy a stock and it hits the price target a week or a month or later, fantastic. Take profits. If the market condition isn't conducive to that, fine. Have lower expectations. The market doesn't care about you. You are irrelevant to the market. If you think that EVs are going to do great in the next 3 years, and the first 2 years they do nothing in terms of the stock price, well, hey, that's the reality of the stock market sometimes, and there's a lot of different macro environmental conditions that can change how fast you get a return if you are right. So at the same time, instead of questioning, well, should I sell out of the stock because it's taking too long? Instead, go back to your price target and see, is my price target accurate? And if it is, keep the stock. If you have a better place to redeploy the capital, you can make that decision on a case-by-case basis, but you have to have a price target and you have to have a clear reason for why you're doing that based on the steps of this philosophy. The other thing is that if you do want to diversify the portfolio a lot more automatically without having to track a lot of different stocks up to 30, you could also use something like a VOO or a VTI, which follow the stock market, the S&P 500 and the total stock market respectively, and that can ensure that you're at least earning benchmark returns and you're getting that stability with the benchmark. Of course, that can drag you down if you're actually very, very good at setting price targets and you get the right market condition, but it can also stabilize you and drag you up if you underperform the market, which statistically, I mean, a lot of people do. So I'm not opposed to having VOO and VTI. Part of risk management is smart diversification. If that means adding a benchmark, I'm not opposed to that, especially if you just have one portfolio. You know, of course, using an index fund removes the price discovery part of this whole philosophy. So it's really just something that you buy and hold, but over the long run, you could see that the total stock market does go up. So at the end of the day, I don't think that you can really go wrong if you're planning on having VOO and VTI in a very, very long-term time horizon perspective in addition to the other stocks that you're trading on a high conviction basis. Building on that, make sure that you're aware of the risk of your portfolio. It's up to you how much risk you take on. If you buy all the best innovative tech companies like Cathie Wood and like a lot of the stocks that we talk about on the channel, you're going to have periods where they do terrible and then periods where they do great and periods where some of them actually end up not working out because a lot of them are so early stage that they're going to have the high risk of, well, not being able to meet the expectations. Now, obviously, we hope that the highest conviction stocks that we do the due diligence on actually pan out very well, but you have to make sure that your risk assessment is well diversified so that you can take concentrated risks and have some of them fail and have some of them do really well and come out doing really well overall. There's a lot of different ways to do that, but if you look at someone like a Cathie Wood, she underperformed the S&P 500 this year. Maybe she's going to do very, very well over the next 10 to 15 years, probably, but if you can't have a year where you can emotionally underperform a major indices in the rest of the market, well, having something like more exposure to different sectors or a benchmark like the S&P is fine. The other thing is don't have a lottery ticket mentality. There's so many people that will go and say, oh, I built my account on 1 or 2 stocks. Great for them. But you don't see all the people that bought one stock, put everything in it, and then lost all their money and then decided the stock market wasn't for them. Don't be a all eggs in one basket type of person. Lastly, and probably most importantly, tune out the noise. It's important to listen to other people's opinions to get different perspectives, but only to a certain point. You need to pay attention to what the company is doing, what the sector is doing, what your analysis said is supposed to be happening, and then comparing it to what is actually happening in the company. You can't get your conviction from people on Reddit. You can't get it from people on YouTube. You have to build this conviction yourself. You can get ideas and perspectives from other people, but if you don't get the conviction from yourself, you're not going to be able to follow the other steps on this philosophy. And you're going to make all the wrong decisions. You're going to panic buy when it's too high. You're going to panic sell when it's too low. Anyways, folks, that caps off this video. This is our last video of the year. Hopefully it provided some value for you. I promise you, if you follow the steps to a T in this and you aim to follow it, you're not going to follow it perfectly. I don't follow it perfectly. It's a struggle. But if you try to follow this to a T, I promise you, you're going to be much, much more likely to do well over the long run. Also, of course, if you are wondering what our price targets are, you want access to our daily morning briefings in ZipTrader U or our step-by-step lessons where we actually go through very, very in-depth about how to break down different types of trades and strategies and different types of setups, well, I'll go ahead and put a link to ZipTrader U if you buy it within the next week. We still have that Goodbye 2021 discount code that's going to be active. Anyways, folks, it means a lot to have spent this year with you, and I'm looking forward to an exciting 2022. Have a good one, and I'll see you in the next video.